Good day. Welcome to another episode of Fog Accountancy Tutorials. Today we are going to continue our study on revenue from contracts with customers, IFRS 15. Now, in a previous video or in a part 1, what we did was that we familiarized ourselves with the 5-step model framework that helps us to achieve the core principle of IFRS 15. And then we solved the question based on the 5-step model framework. Now in this video, I'm going to continue from the 5-step model framework. But this time it will not be an overview. I'm going to deal with each of the steps one by one. So I'm going to begin again from the first step. So we are going to do a quick recap of the 5-step model framework. And then I'm going to take each step and then go deeper and give us some conditions and some provisions that have been made in the standard IFRS 15 concerning each of the steps. And where necessary, I'm going to solve a question to try and enhance our understanding of this standard. And so without wasting my time, let's do a quick recap of the 5-step model framework. So now, the 5-step model framework is a framework that helps us to recognize revenue in a manner that depicts the transfer of goods and services and at an amount that reflects the consideration. Now, this is the 5-step model. The first one is to identify the contract with the customer. And the second one is to identify the performance obligation in the contract. And then, as you can see, third one is determine the transaction price. And the fourth step is to allocate the transaction price to the performance obligations in the contract. And then finally, you recognize revenue when or as the entity satisfies a performance obligation. And so this is the 5-step model framework. Now, what I'm going to do is that I'm going to pick each of them as something like a subtopic, and I'm going to deal with them one by one. So we are beginning with the first one. Identify the contract with the customer. Identify the contract with the customer. So the first one, identify the contract with the customer. Now, this is more theoretical because before you can establish the fact that there is a contract between the entity and the customer, certain conditions must be met. And that is the conditions that I'm going to expose you to. Conditions that must be met for the entity to acknowledge that, yes, there is indeed a contract in place with a customer. If all of these conditions are not met, you are not supposed to conclude that there is a contract with a customer, but you continue to reassess to be sure that all these conditions are in place before we can say that there is indeed a contract with a customer. And so if you don't get yourself familiar to these conditions, you may get a question where they will mix up and then give you certain conditions and ask you to determine whether there is a contract in place with the customer or not. Now, I'm going to put it on your screen and we are going to discuss each of the conditions that must be satisfied for an entity to conclude that indeed there is a contract in place with a customer. So look at what we have here. Now, a contract with a customer will be within the scope of IFRS 15 if all the following conditions are met. Now, all of these conditions must be met. That is it. We are not saying that we are going to let maybe 3 will be in place and 2 will not be in place, 1 will be in place, the others will not be in place. No. Or even if only 1 is not in place, we are not accepting the fact that there is a contract. So for a contract to be within the scope of IFRS 15, all of these conditions that we are going to mention must be in place. The first one is that the contract has been approved by the parties to the contract. The contract has been approved. So if there is no approval, there is no contract. The second one says that each party's right in relation to the goods or services to be transferred can be identified. So you see, the first one is that there should be contract approval. I'm trying to make it quite easier. So there should be contract approval. So once there is no contract approval, we cannot say there is a contract in place. Of course, once I have not approved, it means there is no contract. If we are two parties to a contract, each of us must approve. And the second one is that all of us, each of us, our rights in the contract should be identified. Rights of each party must be identified in the contract. So that is the second point. I'm trying to put out the key things that will help you remember each of the conditions that must be satisfied for a contract to be in place. Now, the first one is that the contract has been approved by the parties to the contract. And the second condition is that each party's rights in relation to goods and services to be transferred can be identified. So those are the two. And then let's look at the third condition. The payment terms for the goods and services to be transferred can be identified. So it means the third point is about the payment terms. You see, I'm just trying to give you a way of making it easier for you to learn. Contract approval, rights, and then the payment terms. So the payment terms can be identified. So once the contract is in place, there should be a clear statement of the payment terms. Will it be paid by check? Will the consideration be paid by electronic transfer? And what should be the condition to be met for payment? What should be done during the payment? What should be done to acknowledge that payment has been received? Everything about the terms of payment and the means of payment must be identified. If not, then there is no valid contract in place. Now, the fourth condition is that there are 5 conditions. The fourth condition is that the contract has commercial substance. There should be a commercial substance. The contract should have commercial substance. You cannot enter into a contract for recognizing revenue when there is no commercial substance. There should be something to be sold and there is something to be bought. Okay, there should be some kind of trade in there. Some goods and service must part way for money to come in. So there should be a commercial substance. Once there is no commercial substance, then the contract is invalid. And the final condition is that it is probable that the consideration to which the entity is entitled to in exchange for the goods or services will be collected. So there should be that higher probability that the money or the consideration can be collected by the entity. Okay, so high probability of consideration or collection of consideration. So yes, there is a high probability that the consideration can be collected. It will not be bad debt or irrecoverable debt. Okay, so ladies and gentlemen, what we are doing is that the 5-step model framework, we are picking each of them one by one and dealing with the issues in there. Now remember that the first step of the 5-step model framework is to identify the contracts with the customer. Now under that, IFRS 15 is saying that before a contract to a customer can be identified, all of these 5 conditions must be met. All must be met. And the conditions are that there should be a contract approval, rights of each party must be identified in the contract, payment terms should be clearly stated, commercial substance, the contract should have a commercial substance, and that there should be a higher probability that the consideration relation to the sale of goods can be collected by the entity. These are the 5 conditions that must be met for a contract to be identified under IFRS 15. So that is all with the first step of the 5-step model framework. Now, when we are done with the first one, then we move to the second point. The second one is about identifying the performance obligations in the contract. And so I'm going to clean this, and I'm also going to put here identifying the performance obligations, and I'm going to tell you what you need to understand there as well concerning the performance obligations identification. And then from there, we'll look at the third one, which is to establish the contract price. And then we'll look at the question for this video. Okay. The second step in the 5-step model framework is to identify the performance obligations. Identify the performance obligations under the contract. Now, this one, there is no much steps or there are no much information to learn here, unlike the first one. All that you need to understand is that at the inception of the contract, the parties or the entity must assess the nature of the contract to determine the performance obligation of the entity. And so the performance obligation could be to transfer goods or series of goods and maybe to perform other services. So there is not much to talk about with the second point. What you need to understand is that once the contract is in place, it is quite easier to be able to determine what you should do because the rights are clearly spelled out as we stated earlier in the first point. Okay, so there is no much to write here. You need to understand that performance obligations will be established, and I've already explained that in the part 1. So that is not my focus. My focus is on the third one. I'm going to move to the third point, which is about the determination of the transaction price, where I'm going to list certain things and I explain them to you, and then we'll based on that to solve some 2 questions. Okay, so there is not much with the performance obligations. Now let's look at the third point, which is the determination of the transaction price. So point 3, determine the transaction price. Now, when it comes to the determination of the transaction price, just as we did for the contract, the first point, identifying the contract, here there are some conditions that we must consider in determining the price. Now, to determine the transaction price is to consider the terms of the contract and then put a value on it. That is going to generate revenue for the entity and to make the required profit. That is fair. Now, what I need you to understand is that an entity cannot just get up and mention a price for the contract, except they consider certain things. So what I'm going to give you, or I'll put on your screen as well, is some factors to consider in determining the transaction price. So in determining the transaction price, the following factors must be considered. Now, the first one is variable consideration. Variable consideration. Now, I'm going to list them all together and then I'll explain together as a whole and then we'll solve a question. So the first one is variable consideration. The second one is the constraining element of the variable consideration. So constraints. Constraining element of the variable consideration. I'll explain that to you, don't worry. And then we also consider the existence of significant financing components. And then we'll look at non-cash considerations. And then finally, we look at consideration payable to a customer. Now, these are 5 factors, even though some are related, okay? These are 5 factors that must be considered in determining the transaction price. Now, I'm going to explain them to you, so please pay attention. The first one is that we consider the variable consideration. Now, what is the meaning of a variable consideration? Variable consideration may occur when there are conditions attached to the contract that may change the value. For example, if you are selling goods to a customer and for you tell the customer that if you maybe there is a return policy where the customer can return any portions of the goods or any quantity of the good that will look faulty within the first 6 months of the delivery. So what it means is that if you deliver 1,000 units of the commodity, there is a likelihood that within the first 6 months, the customer can return like 200 or 100 units. You cannot determine. Okay, so if this happens, and you know that it's in the contract that once that those quantities are returned, there will be a refund of the money. So it is very difficult to set the transaction price for a contract that has variable consideration. So what it means is that the consideration itself can vary depending on how many units of the goods that will be returned. Okay, so that is just an example of and these things become constraints. So the constraining elements are related to the determination of the variable consideration. So we consider the variable consideration and all the constraints that come around it. There are some organizations that have practiced this return of goods for a long time, and they can easily predict that for this type of good, when it goes out, 20% usually comes out. Those ones are even still not accurate predictions. However, they can be able to get some kind of accuracy, and the deviation may not be that much. And it is not only about return of goods. Sometimes some organizations can even promise bonuses to their customers or rewards to their customers when they cross a certain milestone in the use of their product. All these things come in and makes it very difficult for the transaction price to be determined, because when you are putting in the transaction price, you should factor the fact that there could be a day that they will achieve that milestone for you to pay a bonus. And if you don't fix a transaction price in such a way that after paying the bonus you still make a profit, you'll be trading for loss. So in order to fix a transaction price, we need to consider a variable consideration element and the constraints that comes with the variable consideration. In determining the value of a variable consideration, there are two methods that we can use. Okay, in determining the value of a variable consideration, you can use two methods. You can either use the expected value, or you can use the most likely return. I'm going to explain these two. The expected value or the most likely return. Now, we are still on the variable consideration, and we are saying that for a contract that has a variable consideration, we need to estimate the contract price using one of these two methods. Either we are using the expected value or the most likely return. What is the expected value? The expected value is about finding the weighted average of all the possible considerations and their probabilities of occurring. So for example, you know that you are likely to get 1,000 units if the chance A occurs, 2,000 cedis if chance B occurs, 1,500 if there is a chance C, and all these chances will have their weights or probabilities of occurring. So you have three possible outcomes in terms of the revenue you will get from the contract. However, each of them will have a probability weighting. So what we do is that we find the weighted average revenue of let's say weighted average consideration of this, and whatever value that we have, we take it to be the consideration, and that is the expected value method. Another method you can use, okay, is the most likely return. Now, these same three, you could determine that, okay, there is a 15% chance of this happening, there is a 5% chance of this happening, but there is 80% chance of the event B. So it means that if you are not using the weighted average, the most likely return is the B. Therefore, we can just pick these 2,000 as a variable consideration. So these are two methods. If you are using the expected value, you find the weighted average. If you are using the most likely return, you just pick the one with the highest probability. That is basically with the variable consideration. And it looks like we are joking, but these things, you could get a question that they will write up in a way that if you don't understand these things, you will not be able to determine the transaction price. And that is why I need you to pay attention to this very well. Okay, so having understood about how to determine transaction price when there is a variable consideration, now let's move on to the C, because the B is together with the A. The C is about the existence of significant financing components. We need to consider the existence in determining the transaction price. We consider the existence of significant financing components. In determining the transaction price of the contract, the entity shall adjust the price for the time value of money, provided that the financing option, provided that the payment timing, the timing of the payment of the consideration, gives any of the parties a significant financing option. For example, if I sell to a company for 4,000 Ghana cedis, and they are supposed to pay, if I am the entity and I'm selling to a customer, and the customer is supposed to pay in 1 year time. Now, what it means is that I have delivered the goods today, but because they are going to pay in 1 year time, this 4,000, which should have been out of their money, remains in the organization, and it is a source of finance for them. So they will use that money throughout the whole year, and at the end of the day, get profits on that before they come and pay this 4,000 in 1 year time. So what it means is that the terms of the payment has provided the customer with a significant financing option. This becomes a source of finance for them. Therefore, because of that, I must consider the time value of money and adjust it on the payment. So what it means is that when they are paying me in 1 year time, they are not going to pay me exactly 4,000. There has to be the time value of money. We use that to calculate and adjust the contract price in order to know how much will be paid at the end of 1 year, just because the payment terms has provided them with a financing option. It could happen to the entity as well, such that the customer rather will pay us today, but will deliver the goods in 1 year time. When that happens, we have gotten an extra source of finance that we are going to use throughout. Before in 1 year time we will deliver the goods. So that means that we must also adjust with the time value of money, and maybe give it to the customer's benefit by either giving them more than what they require or letting them pay less today. So there has to be an adjustment of the time value of money once the terms of the payment of the contract provides any of the parties with a significant financing option. I don't know if you understand what I'm trying to explain. Okay. Now, the next thing to consider is a non-cash consideration. Now, when we say non-cash consideration, it means that most of the time they are notional issues, okay? They are not so important, but sometimes you need to consider the non-cash effect of whatever transaction that you are doing, and it may influence the way. When I say non-cash, there's some energy that you use in carrying the goods. If you are not charging for that, somehow you lose. Okay, it's called notional cost, and we need to consider all of those ones in fixing or determining the transaction price. And then the final one, which is also very important, consideration payable to a customer. We must factor the consideration that is payable to the customer in determining the contract price. Now, the consideration that is payable to a customer will be better illustrated in the question that I'm going to solve. But what I want you to understand is that there are times where, as part of the terms of the contract, the entity will need to pay the customer for something. For example, if for delivering the goods, the customer may use his own vehicle to come and pick. Maybe in the terms of the contract or the normal business practice is that for the goods that you are selling to the customer, you should have sent them by your own vehicle, but something happens and you couldn't, and the customer has to use their own vehicle to come and pick up the goods from your warehouse to their place. When it happens, you are likely to pay some consideration to the customer to compensate the customer for what they have incurred on that. So when it happens, the contract price will be reduced by the consideration that you are paying, okay, to the customer. And that will be better illustrated in the next question that I'm going to solve. So these are 5 conditions that or factors to consider in determining the transaction price. I'm going to solve a question, but before that, I'm putting this on your screen for you to look at it again. So, factors to consider in fixing the transaction price. 1. The variable consideration. Constraining estimate of variable consideration. The existence of a significant financial component in the contract. Non-cash consideration and consideration payable to a customer. These are the 5. So I'm going to solve a question with you right now, and then we would know what next to do. Okay, so let's look at this question together. Golden Gate Co. Golden Gate Company enters into a contract with a major chain of retail stores. The customer commits to buy at least 20 million Ghana cedis of products over the next 12 months. The terms of the contract require Golden Gate Company to make a payment of 1 million Ghana cedis to compensate the customer for changes that it will need to make to its retail stores to accommodate the product. By 31st December 2018, Golden Gate Company has transferred products with a sales value of 4 million to the customer. How much revenue should be recognized by Golden Gate Company in the year ended 31st December 2018? So this is a very easy way. There are quite some principles that are here to apply. I mean, there is a contract, there is a performance obligation, but the most important thing here that they are testing is about determination of the contract price. And you could see that in this question, there is an amount, a consideration to be paid back to the customer. So let's go back and look at it, and then we'll come back and I'll show you something. Golden Gate Co. enters into a contract with a major chain of retail stores. The customer commits to buy at least 20 million of products over the next 12 months. So the customer is going to buy 20 million over the next 12 months. Please take note. The customer commits to buy, that is in the term of the contract, 20 million worth of goods over the next 12 months. We continue. The terms of the contract require Golden State to make payment of 1 million to compensate the customer. So there is consideration to be paid to the customer to compensate the customer. 1 million. So please take note. The customer has committed to buy 20 million. So this is how much we are taking from the customer. However, we are also going to pay back 1 million to the customer as compensation. Please take note. So you see that when we net it off, the commitment becomes 19 million. But let's read and see. By 31st December 2018, Golden Gate Co. has transferred products with a sale value of 4 million to the customer. How much revenue should be recognized by Golden Gate in the year ended 31st December 2018? Now, so they have actually transferred 4 million worth of goods by the year end. So how much should they, Golden Gate Company, how much should they recognize as revenue for the year? This is a very easy thing. The commitment and the term of the contract is that we are going to supply the customer with 20 million worth of goods. But have we done that? So you see, this is the performance obligation. But we cannot recognize revenue if we have not performed the performance obligation. And what we have transferred so far is 4 million. So prudently, we can only recognize 4 million as revenue. However, when the contract stated the 20 million, we also stated that there is a cash back to the customer for 1 million. And so if we have actually transferred 4 million, how much are we going to recognize? We need to reduce the quantity that we have supplied by the value of the cash back that is also commensurate or matching with the goods transferred. And we are not going to reduce this by 1 million. We need to work with fractions. Now, what percentage of the original 20 million is the 1 million? That is what I want you to understand. You see that for this 20 million, we're supposed to return 1 million cash to them. So if we have given them 4 million, how much are we supposed to return? You can use mathematics to do this. Mappings, and then you do cross multiplication. Or you can just find percentage. What percentage of 20 million is the 1 million? It is 5%. So because 1 over 20 times 100 gives us 5%. So it means that 5% of the 4 million will also be a cash back. Or better still, you can look at it this way. 20 million divided by 4 is 5. So the same way, if you divide this one by 5, it will give you how much you pay back. So 5% of the contract value is to be a cash back to the customer. So if we have actually performed only 4 million for the year ended 31st December 2018, then what we need to do is that the cash back that we are giving to the customer will be 5% of the 1 million. And that is going to be 0.2. And therefore, if we take out 0.2 from 4 million, the revenue to be recognized at the end of the year is going to be 3.8 million. And this is what the examiner expects you to get. So what we are trying to say is that even though we have transferred 4 million worth of the goods, we need to pay back 0.2 million to the customer. That is a fraction of a proportionate fraction of how much we are supposed to give in all per what we have supplied. So in the year end, Golden Gate Company will recognize 3.8 million in their financial statement for revenue from the contract. That is what we are saying. I don't think this is very difficult for you to understand. And this will bring us to the end of the part 2 of our lesson on IFRS 15. Now, in the part 3, we are still going to continue with dealing with the element. Or the steps, the 5-step model framework. We are left with the 4th step, which is to allocate the contract price to the performance obligations, and the final step, which is to recognize the revenue. So we are going to deal with that and the conditions that are attached, and then we'll look at other factors that are part of the standard before we can say we have concluded on IFRS 15. Remember to subscribe to this channel if it is your first time. Share this video and let others also have a benefit. And until we meet again for part 3, it's bye for now. Thank you.